Hi, I'm just back from a week in Asia where I had the opportunity of brainstorming with some of the key policymakers, sovereign wealth funds, and CEOs of a major financial institution. Japan, the surprise, corporate action led by politicians, regulators, and boards to improve return on equity. We understood that return on equity equal investments, investments equal growth, and if you don't make money, it's hard to be able to compete. So big change in cultural attitude across corporate Japan. Nikkei remains the favorite play. Yen, right now, it's way undervalued at 155. India is the place where most global investors have gone to, leaving China. It's now seen as expensive, lots of expectation embedded, and probably toppish. China, bottoming out. Consumption is improving, sales quarter on quarter and year on year are getting better. Xi refocusing on the domestic issues, and we think that the core high quality company in China are now undervalued, and when every US asset manager tells you that it's uninvestable, it's probably time to step in and take the opposite view. Europe seen still as basically the referee of an Olympic, which is played by China and the US, and Europe is not even trying to play any longer. As a result, less investments in Europe has become a harvesting for yield, not much for growth. US, big uncertainty on US debasement. Dollar debasement, US is printing 7, 8, 9% deficit each year. Long-term deficit not getting any better. Both parties only talk about spending more, and public debt to GDP rising above unsustainable level in the medium to long term if you add unfunded liability. Notable, the China Central Bank, Bank of Singapore, the South African Bank are selling treasury and buying gold with the fear of a further dollar debasement as it happened in the early 70s. Donald Trump here, it's a risk, and overall, this is something that is in every policymaker's mind. As far as US market, dichotomy between now the Magnificent Seven, which are de facto becoming monopoly in their own right, and they can keep on getting better, and particularly with role of AI, which requires scale and massive capex. Overall, though, market seen as toppy, lots of priced in, and probably the income strategy in which we focus in financials, equity and credit, developing yields expected on a 3-year view between 9 and 10% in dollar for balanced strategy, in my view, remain the most valid, as we get paid 9 to 10% for the next 3 years to see what's happening in this complex world, which remains uncertain. US with 4% salary growth, 7-8% deficit, is not seeing inflation coming down anytime soon, and hence all these expectations of rates cuts, in my view, are misplaced. Last but not least, uncertainty in global private assets. Private equity now have more than $3 trillion of equity they own that they need to sell. IPOs are all-time low, despite the strong market performance. And now there is a feeling that this hype in private credit is nothing else but trying to raise credit to get out your equity check, leaving the bag to the newest private credit investors. And here I think what is interesting is I've heard of some transaction out of sovereign wealth fund buying a 30 to 50% discount private exposure held by public pension fund in Europe and the US that have overinvested in public markets and now short cash. And with the high interest rates environment, they need to meet even higher liabilities. And this is basically, it's putting a big strain on private assets.